A concerning development is unfolding across California, as Walmart has made the difficult decision to cease operations at over 250 locations within the state. This is not a matter of consumer preference or competitive pressures, but rather a straightforward financial calculation. The arithmetic of maintaining these stores no longer yields a viable result. While state officials engage in discussions regarding the narrative, countless families are confronting the practical realities. Diminished access to goods, increased travel distances, and the gradual erosion of a retail framework that has served communities for generations. This is a present and active situation, the implications of which merit the attention of thoughtful citizens everywhere. This platform is dedicated to examining the consequential stories that often escape the spotlight of conventional media. If you appreciate independent inquiry that traces the flow of capital, scrutinizes consequential decisions, and asks steadfast questions of those in authority, then I invite you to subscribe. If you find value in this discourse, please like this video and share it with others who might be interested. I would also pose a question for your consideration. What is the distance you must travel to reach your primary grocer? For a growing number of Californians, that journey is becoming significantly longer. Let us examine the situation. This narrative transcends simplistic labels of corporate avarice or market malfunction. It is, at its core, a study of economic incentives, regulatory mandates, and inescapable financial realities. Over the past year and a half, California has enacted a series of wage policies, regulatory measures, and enforcement actions that have fundamentally altered the operational cost structure for large-scale retail. Walmart, as the nation's largest private employer, has performed a thorough fiscal analysis. That analysis has concluded that continued operation under these conditions is untenable. What we are witnessing is not a capricious choice, but the inevitable outcome of policies that disregarded foundational economic principles, placed considerable burdens on employers, and operated on the assumption that enterprises could perpetually absorb escalating costs. This is not a sustainable proposition. The individuals who will bear the steepest cost for this miscalculation are those least equipped to manage it. To understand how we arrived at this point, we must look to April of last year, when California's new minimum wage statute for large retail and grocery workers took effect, setting the hourly floor at $22. While framed with compassionate intent, the practical impact was a severe financial disruption. Grocery retail operates on notoriously slender profit margins, typically ranging from 1% to 3%. When labor costs, already the most significant operating expense, increase abruptly by approximately 35%, the entire model is destabilized. Financial reports from California locations soon revealed stores that were marginally profitable were now sustaining losses, particularly in rural and lower-income areas, with lower sales volume and higher operational challenges. Consequently, the very communities the policy aimed to assist were the first to be deemed no longer viable. The financial burden extended beyond wages. California simultaneously enhanced its regulatory enforcement capabilities. The state's labor office, already vigorous in its oversight, gained further resources for unannounced audits and investigations. Penalties for infractions, such as scheduling errors, could now reach $10,000 per violation. The projected cost of maintaining full compliance across the state's complex and evolving labor code was estimated to add tens of millions in annual expenses. This was compounded by rising losses from inventory shrinkage and sharply increasing commercial insurance premiums. By mid-year, corporate leadership was presented with a set of unappealing options: absorb unsustainable losses, raise prices and risk driving customers away, or consolidate operations. The outcome was a directive to identify every California store that could not meet a modest profit threshold under the new cost structure. The resulting list contained 264 locations. The repercussions followed in sequence. The initial announcement of closures affected 52 stores and 11,000 employees. In several communities, these stores represented the only full-service grocery option within a substantial radius, creating immediate pockets of food insecurity. The secondary effects then rippled outward. Small, family-owned businesses that relied on the customer traffic drawn by these anchor stores began to falter. Hardware stores, salons, and cafes found their livelihoods threatened. Municipal budgets, dependent on sales and property tax revenues from these commercial centers, faced shortfalls impacting public services. State leadership responded not with reconsideration, but with escalated confrontation, launching investigations and alleging violations. This political response served only to incur millions in additional legal fees for the company, further cementing the financial imperative to exit. Subsequent waves of closures followed, ultimately affecting 38,000 jobs and leaving 147 communities without a proximate, full-service grocery provider. Attempts at compromise, where the company proposed a phased implementation of new rules, were rejected by state officials. The consequences are now crystallizing. California's budget, heavily reliant on sales tax, faces an estimated $800 million shortfall in projected revenues from this sector. Corporate tax receipts have similarly declined. The state's strained unemployment system is burdened with new claimants, while the social safety net those individuals might rely upon is itself facing cuts due to reduced revenues. This is not an isolated incident. Other major retailers, including Target and Kroger, are enacting similar strategies of consolidation and retreat in the state. Independent grocers are filing for bankruptcy at an alarming rate. The void is being filled primarily by online platforms, which operate under a different set of rules and logistical realities. The fundamental lesson is that markets respond to incentives. When the cost of conducting business is raised to an unsustainable level, business activity diminishes. When employment is rendered prohibitively expensive, employment opportunities contract. The individuals who pay the price for ignoring this reality are not the policymakers in Sacramento, but the Mariahs in Stockton and the Roberts in Modesto, the dedicated employees and residents whose stability has been upended. As some communities attempt to adapt with mobile markets or cooperatives, and as some families make the difficult decision to relocate to states with a lower cost of living, the long-term political and economic contours of the state are being reshaped. This Californian case study carries a national implication. Legislators in other states are observing these events. The choices made today will determine whether this remains a localized challenge or becomes a broader pattern. Thus, I return to my questions for your reflection. Who ultimately benefits when the regulatory environment leads to the departure of established retailers? Who gains influence when communities become dependent on a limited number of distant, digital platforms for essential goods? And who truly bears the cost when ideological posturing is prioritized over pragmatic economic stewardship? If this examination resonates with you, I welcome you to subscribe. Please like this video if you found it informative, share it to further the conversation, and feel free to offer your perspective in the comments below. This story continues to unfold. Thank you for your time and consideration.